Hey guys, welcome back. In the previous episode, we have discussed about breakout trading in great detail. Now, breakout trading is one of the oldest trading styles in the book. You watch the price consolidate within a range, and then when the price breaks out of that range, you bounce onto the trade and enjoy the benefits of a strong move. And often when the price has been stuck in a range, it will move out of that consolidation range with some good momentum, giving the traders a good profit potential. But, and it's a big but, the breakout pattern has an evil twin, which is actually a curse to all the breakout traders, and it's none other than the fakeout. If you have ever traded breakouts, you'll recognize this situation. Just when you think you have caught the big move, the market turns against you and shakes out of your trade. So, how can we tell the difference between a breakout and a fakeout? Now, there are a number of tools that traders can use. But the first thing I have to let you know is that there is no way you can avoid false breakouts completely. There are certain times, no matter how good a setup you have, you're still going to get caught in a false breakout. But we can minimize the chances of getting caught in a false breakout. We have got some price action methods and some tips that you can make use to minimize your chances of getting a false breakout. With that being said, the first tip I have for you is to stop chasing the power moves or stop going after the power moves into an area of value. What are power moves? I have talked about power moves in the episode 6 of this price action course when we talked about reversals. But let me talk about it briefly so as to brush up your memory. If you see a big or strong momentum move with large candles, this is what a power move is. Now if the price moves up from a level with little or no pullback and then it goes up higher, breaking an area or a level of value like a support or resistance, then my advice is not to chase the breakout of this type, because more often or not, the market tends to reverse under these conditions. And why am I so sure, and why is it so? Let me give you a very simple explanation of why this actually occurs. When you chase a market where the price is making a strong move or a power move, there is no floor or support to these higher prices. Now if you look at the chart, most of the time the price exhibits a specific type of price action where the prices goes up and then retraces or pulls back. In this type of price action, there are levels like swing lows to support these higher prices. What this means is that, for example, take the case of a resistance. If the market were to reverse from the resistance, it would find a floor or a support where potential buying pressure could push the price higher. These types of moves are more sustainable because they are a series of higher swing levels along the way to support these higher prices. Now what happens when the market has given a power move into a level? In this case, let's talk about a resistance level. It means that there are no intermediate swing levels to support these higher prices, or there is no obvious levels for the buyers to come in to oppose the sellers if they sell at the resistance. Now the only possible area for buying is the previous support level, and so there will be a lot of sellers waiting at the resistance to sell, and also there will be a lot of buyers who looks to buy the breakout, who would place their stop losses below the resistance. Now there is a cluster of sell orders below the resistance by both the sellers and the buyers. And by some chance, if the price manages to reverse, all of these stop losses would be triggered, which will induce further selling in the market, and the market will reverse even lower. And there is a good chance if the reversal comes, it can be very swift towards the downside to the nearest support level or the floor area where the buyers could then potentially come in. But this is going to be a huge distance, and for any buyer who hasn't placed a stop loss can end up bleeding his account. So as a matter of fact, you want to stay away or stay on the sidelines if you are a breakout trader under such conditions where there is a power move in the market to an area of value. Now we will look at some price action tricks that you can easily apply on the market to stay cautious of the fakeouts. However, the problem with each of them is that you are left waiting for the candles to form their patterns. And sometimes this might be a reason for missing out on some of the trades. So it's up to your decision making as a trader in the real market conditions for them to make any sense. Now there are clues in the candlesticks and volume data which can give information whether The breakout is a genuine breakout, and these are worth considering and can be used in conjunction with other tools like indicators. A breakout occurs because the price has been contained below a resistance level or a support level for potentially some period of time. Now the resistance or support level becomes a level which many traders use to set their entry points or stop loss levels. So when the price breaks through the support or resistance level, the traders waiting for the breakout would jump in, and those who did not want the price to break out will exit their positions to avoid larger losses. This is very much clear. Now this flurry of activity will cause the volumes in the market to rise, which shows a lot of traders were interested in the breakout level. Now the higher than average volume helps to confirm that it was a breakout. But if there is a very little volume on the breakout, then the level may not have been very significant to a lot of traders, or not enough traders felt convinced to place a trade near the particular level. And most of these low volume breakouts are likely to fail. In case if we are talking about an upside breakout, if it fails, the price will fall back below the resistance level. And in case of a downside breakout of a support, often called as a breakdown, if it fails, the price will rally back above the support level. In some instances, even after a high volume breakout, the price will often retrace or pull back to the breakout point before moving in the breakout direction again. This is because the short-term traders will often buy the initial breakout, but they will attempt to sell quite quickly for profit. This selling by the short-term traders will temporarily drive the prices back to the breakout point. Now, if the breakout is legitimate, then the price should move back in the breakout direction after the retest or pullback. And if it does not, it is a failed breakout, and the prices would reverse. Analyzing volumes were one way of identifying if it is a breakout or a fake out. But as I have mentioned earlier, it does not work every time, and there are occasions when this idea will fail. So let us consider a few more ideas to keep in mind so as to distinguish between a fake out or a breakout. The first thing is that you have to wait to see if the candlestick closes through the line of support or resistance, which means that the real body of the breakout candle should close above the resistance level, or the real body of the breakout candle should close below the support level, which in turn means that just a wick poking through the level is not enough to confirm a breakout. So it's a good rule to follow, but on its own, it's not particularly reliable. Now the second thing is that you have to wait for a close beyond the support or resistance level, and then you have to wait for the price to retrace back to the level or pull back by a little bit and then move in the direction of the breakout, and this candle should close beyond the closing price of the breakout candle. This is a resistance turned support or a support turned resistance method, which is a reliable way to trade breakouts. But on the downside, there is a lot of patience required because there is a lot more waiting around, and sometimes the prices won't even retest or pull back to the level, and chances are you might miss the trade. Now the third point is to look for big candlesticks, which will indicate that there is momentum behind the breakout, and you have to check for large breakout volumes, which is higher than the previous volume. But on the downside, a very large candle means that you have potentially missed a hefty part of the move. So it can right away affect your risk to reward as well as the placement of your stop losses. And the final point to keep in consideration is that you have to look for a price build-up at the market structure, which may be a tight consolidation near the area of value, or higher lows into the resistance similar to an ascending triangle, or lower highs into the support similar to an ascending triangle, which are credible enough patterns that can give you high probability breakout trades. You can learn a lot more about them in the previous video. Now we will look at a faster way to get a breakout confirmation using an indicator, which will give us an immediate yes or no confirmation as to whether we can rely on this breakout or not. So we have to add the RSI indicator or the relative strength index indicator in our chart. So when we are looking for a breakout, we are expecting the breakout to come with a degree of momentum, and we will use the RSI indicator to find that momentum. So basically RSI is a momentum indicator and it measures the speed of a move. So if the speed is increasing, the momentum will be building or increasing. In this particular scenario, I am talking about RSI convergences. RSI convergence occurs when the RSI direction mirrors the price trend. For example, if the price of a security trends upwards, then the RSI will also trend upwards. This is what I mean by RSI convergence. So if the price is moving up through an area of value, we want the RSI indicator to be showing higher highs, which signals building momentum or increasing momentum. The idea is that if the market momentum is increasing, the RSI should also be increasing. The same is true if the prices are headed down and breaking through the value of support, which will indicate a momentum towards the opposite direction or the downward direction in the RSI too. So this confirmation for both bullish and bearish signals are generally more useful when the RSI period is 14 days or more, and anything below the 14 period may be typically considered less reliable for confirming the convergence. And of course, no indicator is infallible, but using RSI to confirm breakouts will give you a significant edge in the market. It adds weight to the evidence of a possible breakout and not a fakeout. So I recommend that you add it in your charts and see what it can do for you. Now coming to the most important part or the important point of this video, you have to backtest these techniques that I have discussed with you so as to understand how reliable each system is, and then choose a system of your liking and convenience, because practice makes you perfect and backtesting can save your account. So that is it for this video, guys. If you have learned something new, I would really appreciate you liking this video, and don't forget to subscribe to the channel. I will see you guys with the next episode. Till then, see ya.